The map of global finance is being redrawn. For decades, the US dollar was the undisputed anchor of the world economy, but now, tectonic shifts are underway, challenging that long-held dominance. At the forefront is China. In a strategic pivot, it has pared its U.S. Treasury portfolio to $757 billion, the lowest in 16 years, aiming to insulate its economy from American influence. Other BRICS members from India to Saudi Arabia are selling as well, shifting reserves into the timeless safety of gold and building new financial hubs beyond Washington's reach. But in a surprising twist, America's closest partners are racing the other way. Leading the charge, Japan now holds a record $1.1 trillion in treasuries, a move that reinforces its deep economic and security ties with the United States. The UK has surged past China with $858 billion, cementing London's role as a key dollar hub. Meanwhile, France and Israel are buying at breakneck speed, despite heavy debts and ongoing conflicts. The net result? Bloomberg estimates that foreign ownership of U.S. debt has climbed to an all-time high of $9.1 trillion. The dollar's role isn't just eroding, it's being fundamentally reconfigured. Yet, as Reuters notes, there's a hidden vulnerability. Much of this is parked in short-term bills, not long-term bonds, a clear signal of caution rather than deep, unwavering trust. This creates a precarious balance. America's lifeline is being propped up by allies already near their own breaking points. The system is increasingly reliant on partners who are themselves stretched thin. The risk is what happens if their cash runs dry. A significant shift is underway in the global financial landscape. For the fourth consecutive month, China's holdings of U.S. government debt have continued their steady decline. According to the latest Treasury data, that figure has now dropped to $756 billion as of May 2025, the lowest level in over a decade. It's a stark reversal from a decade ago, when Beijing was Washington's largest foreign creditor, controlling over $1.3 trillion. For years, buying U.S. debt was a cornerstone of China's economic strategy, helping manage its currency and recycle huge trade surpluses. Now Beijing is deliberately letting that massive pile erode. This isn't a panicked sell-off, but a slow, calculated withdrawal of cash from Washington's most vital funding source, a move many analysts see as a clear step toward de-dollarization. But here's the paradox: as China steps back, others are stepping up. Overall, foreign demand for U.S. debt has never been higher. International investors now hold a record $9.13 trillion in U.S. treasuries, a jump of nearly $1 trillion from last year. However, a closer look at the data reveals a significant geopolitical realignment. The new wave of buyers aren't emerging economies like China or its BRICS partners. Instead, the capital is flowing from America's strategic allies. Japan, a key U.S. partner in Asia, has led the charge, boosting its stake to an unprecedented $1.147 trillion. The United Kingdom, leveraging its role as a global financial hub, has vaulted into second place with holdings of $858 billion. Other close partners are following suit. France added a substantial $70 billion over the past year, while Israel boosted its holdings by 46%, an increase of $32 billion. The trend among the BRICS nations tells the opposite story. This bloc is actively trimming its exposure. India has cut its holdings by $14 billion. Even Saudi Arabia, despite massive oil surpluses, has been reducing its stake, while Brazil shifts its reserves into other assets. China's reduction has been the most pronounced, offloading $57 billion in 2024 alone. To avoid rattling markets, some sales were discreetly routed through custodian accounts in Belgium and Luxembourg, obscuring the true scale of the divestment. So where is that money going? A significant portion is being converted into gold. Beijing has been on a buying spree, adding 15 tons in late 2024 and storing the bullion in new high-security vaults in Shanghai and Shenzhen. Allies taking up the slack aren't exactly flush. Britain faces its steepest borrowing costs in 27 years. France's yields now top Greece's. Israel's defense spending is soaring. Japan is juggling record pension, healthcare, and defense bills. They buy treasuries less because their finances are strong than because supporting Washington fits their strategy. That commitment isn't infinite. Treasury data shows foreign central banks sold nearly $20 billion in long-term bonds this May, favoring short-term paper. The appetite to park cash in Washington is still there, but the confidence to lock it up for decades is fading. This wasn't how the system was meant to work. For decades, the global financial order ran on a simple, powerful principle, a grand bargain born from the post-Bretton Woods era that seemed unbreakable. For 40 years, U.S. trade deficits recycled into treasuries almost automatically. It was a symbiotic loop. The U.S. financed its consumption on credit, while exporting nations found a safe haven for their dollar reserves. Between 1980 and 2011, over $8 trillion of deficits looped back as foreign lending, a mechanism the IMF said sustained both U.S. consumption and global growth. That loop is breaking. Geopolitical tensions and the use of financial sanctions have accelerated a global search for alternatives. BRICS surpluses no longer funnel into treasuries. They're moving to gold, local currency trade, or banking hubs in Hong Kong, Dubai, and Riyadh. This isn't just diversification. It's a strategic pivot away from the dollar-centric system. China is even lending dollars abroad at lower rates than Washington pays. It's a signal that Beijing is now acting as a rival financial power, using its reserves to expand its influence. Saudi Arabia still prices oil in dollars but recycles fewer back into U.S. debt. Those petrodollars now fund ambitious domestic projects and global investments through its sovereign wealth fund. Allies' big purchases look less like routine support and more like emergency cover. The numbers line up. Japan added $56 billion over 12 months, the UK $112 billion, France $70 billion, Israel $32 billion, roughly matching the BRICS sell-off. Total foreign holdings rose to record highs, but who holds them has flipped. The once broad base of global creditors has narrowed to a core group of political allies, a fundamental shift for the system. And the US keeps borrowing more. Over $2 trillion a year through 2028, the CBO projects, with interest alone topping $1 trillion annually by 2026. Allies can soak up some of that, but not forever. Markets are already flashing warnings. 30-year Treasury yields reached 5% in September, their highest since before the financial crisis. British gilts, Japanese notes, all are paying levels unseen in decades. Buying U.S. debt now carries a cost on both sides. France faces election turmoil over budgets. The UK is wrestling with record borrowing costs. Japan must fund both an aging society and new military plans. Israel is fighting on multiple fronts. Their willingness to back treasuries is clear, their capacity is fragile. China's exit is measured, not panicked. A steady drawdown, more gold, more short-term bills, some assets hidden via Europe. The aim? Insulation, not confrontation. Equity flows tell a different story. In May, foreigners bought $114 billion in U.S. stocks, even as they stayed cautious on long-dated bonds. The IMF notes the dollar's share of global reserves has fallen to 58%, down from over 70% 2 decades ago, while gold is back to 1970s levels. This isn't sudden de-dollarization, but a slow rebalancing. By late summer 2025, America's debt sales remain oversubscribed, thanks to allies and private money. Yet its biggest rival is quietly unwinding, and the supporters replacing it are stretched. Washington must refinance trillions at rising yields each year. Foreign backing is strong but thinning. Allies are buying, at a cost. Rivals are selling, with care. The Treasury market is steady but precarious. Hedge funds have piled into Treasury futures, magnifying swings. Open interest is near its highest since 2008. Foreign bids now concentrate in short-term bills. 65% of purchases versus 48% 2 years ago. Even sovereign wealth funds like Norway's are trimming dollar bonds at the edges. Credit default swaps on U.S. debt have quietly doubled since early 2024. Demand persists because the alternatives are worse. Fragmented euro bonds, ultra-low Japanese yields, politically risky Chinese assets. The U.S. remains the least imperfect borrower, a shaky foundation for the world's reserve currency. If rivals won't fund U.S. deficits and allies have limits, what happens when those limits are reached? Thanks for watching this Geoscope report. If you found this breakdown useful, remember to like, subscribe, and explore our other videos on global finance and geopolitics.